Why is the S&P 500 dropping today? Inflation fears are capping equity multiples again, and the 20-day moving average rollover is accelerating. S&P 500 gamma levels are clustered near 7,300, and dealer hedging is amplifying the slide. Traders searching for S&P 500 support zone today will find 7,255 as the first real floor, but a daily close below it opens the trapdoor to 7,123 and 7,000. Right now, the S&P 500 is trading at 7,267 after a single session that wiped out over 119 points. But here's what most traders completely missed. The market did not break down from a neutral zone. It rejected the most important pivot of the month at 73.69 with the force of a liquidation cascade, and that failure just unlocked a 200-point trapdoor. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end, and I'm giving you 3 exact levels you can trade tomorrow, with stops, targets, and risk-reward ratios that make sense in this volatility regime. The session bias is straightforward. We're fading all pops and respecting the bearish intraday trend until proven otherwise. The hourly and 5-hour trends are aligned to strong sell. The daily trend has flipped to strong sell, while the weekly and monthly still show strong buy. That means we are inside a corrective pullback within a secular uptrend, and that pullback is accelerating. Write this number down. If the S&P 500 breaks and holds below 72.55 on a 4-hour closing basis, the entire multi-month structure resets, and 71.23 becomes the magnet. Above us, the single invalidation level that flips this bearish sequence back to buy the dip mode is 7,369. A daily close back above 73.69, and the melt-up narrative is alive again. Right now, the herd is positioned net long, average entry near 7,400, and they are all underwater. That underwater positioning makes every bounce a potential liquidation event, and that's exactly where the opportunity sits. Let's walk the chart from the weekly canvas down to the 60-minute noise. On the weekly, price is still far above the 200-week moving average, which sits quietly around 4,700, not in play. But the weekly MACD is rolling, and we just printed a bearish engulfing candle that swallowed 3 weeks of grind. That's the first warning shot. Drop to the daily time frame. Here's where it gets brutal. The 20-day moving average is at 7,426, the 50-day moving average rests at 72.71, and we closed at 7,267, below both. The 200-day moving average is way down at 68.50, so the long-term structure is still intact, but the short-term moving averages have crossed into bearish alignment. The 5-day and 10-day MAs are at 73.88 and 74.35. Now acting as dynamic resistance overhead. The daily RSI has collapsed to 40.6, not yet oversold, meaning there is room to fall before any mean reversion bid. The daily MACD line is printing 59.58, but the signal line is turning down, and we are seeing a bearish momentum divergence that has been building for 2 weeks. In plain language, buyers are exhausted, and the engine is stalling. Now zoom into the 4-hour chart. The 50 MA on the 4-hour sits exactly at 73.12, and every single bounce over the last 24 hours has been capped below it. That level becomes my active trader's reference. The 4-hour MACD is deep in negative territory, histogram accelerating lower, and no divergence yet. This is trend continuation behavior. On the 60-minute, we've got a series of lower highs right at the 7,295 region, and volume spikes on red candles confirm institutional distribution. Key support levels. 72.55 is the first structural floor. This is the March swing low and today's S1 pivot support. Below that, 71.23 is the next big demand zone, followed by the psychological magnet at 7,009. Which aligns with the 100-day moving average at 7,089 acting as a magnetic cluster. On resistance, 73.69 is the daily pivot and the gatekeeper. Above that, 7,500 is the first real ceiling, with the R2 at 77.14 and a 3 at 7,745 as extension zones if a melt-up resumes. Here's what most traders miss. The S&P 500 is moving tick for tick with real yields, and real yields just broke out to the upside. That reprices equity risk premium instantly, and it explains why tech and growth names are bleeding while the Dow lost 1.87% in a single session. The 10-year yield pushing higher is acting like a silent wrecking ball, and the index is absorbing that shock right now. The 200-point range between 72.55 and 74.50 is a volatility compression coil, and we are at the release point. The next direction from here will be violent and swift. The core news from the last 24 hours is not just a red close. It's why U.S. stocks closed sharply lower, the Dow Jones Industrial Average down 1.87%, and the S&P 500 sell-off shows inflation risk is still capping equity multiples. That's the analyst consensus bleeding through the tape. Yesterday's CPI-related fears repriced the terminal rate expectation, and the dollar caught a bid simultaneously. The S&P is correlating inversely with the DXY right now, with a one-day correlation coefficient spiking above negative 0.8. What does that mean? It means the dollar killers, like euro and cable, are under pressure, and commodity currencies like the Aussie are acting as the China proxy, selling off with industrial metals. Gold, the fear architect, is actually holding firm because real yield pain is competing with geopolitical bid, but equities are not getting that safe haven rotation, they're getting pure multiple compression. The institutional flow picture confirms it. ETF flows into SPY and IVV turned negative in the last 48 hours. Put-to-call ratios on the index have spiked above 1.2, showing hedges are piling in. Gamma levels are clustered at 7,300, and with the index below that, dealer hedging is pressing the downside. The directional lean for the next 1 to 2 weeks is lower, targeting that 7,123 demand zone, unless 73.69 is reclaimed. The exact event that invalidates this bearish lean is a daily close above 73.69 with volume. Until then, short bounces have the edge. Do you think the S&P 500 breaks 7,000 within 2 weeks? Comment yes or no right now. I'm tracking consensus, and in tomorrow's video I'll reveal the split. Most people skip this section. That's exactly where the money is made. Keep watching, because these 3 plans cover every scenario from the patient sniper to the aggressive scalper. Strategy 1, the sniper, conservative. This setup waits for the structural breakdown to confirm, so you avoid getting chopped up in noise. Trigger condition. The S&P 500 prints a 4-hour close below 72.55. Not a wick, a solid body close below that level. The confirmation signal is an increase in the 4-hour volume above the 20-period average on that break. Entry. Sell stop at 72.53 on a retest of 7,255 as new resistance, or aggressive limit order as soon as the 4-hour candle closes below 7,255 and we get a small pullback into 72.60. Stop loss goes at 72.95, above the 60-minute lower high. Logic. If the breakdown fails and price reclaims that swing point, the bearish structure is invalidated. Take profit 1 sits at 7,125, just above the S2 support at 71.23, for a 170-point move from entry around 72.55. That gives a risk of 40 points and reward of 170, a risk-reward ratio of roughly 1 minute and 4.2 seconds. Take profit 2 extends to 7,010, right above the 7009 S3 cluster. A partial profit strategy at target 1 and then trailing stop by 30 points once target 1 is breached is advisable. This entire setup is void if the S&P 500 daily close is above 73.69 before the trigger fires. That would mean the bulls absorb the selling and the melt-up thesis is back on to the sniper, conservative, entry. Sell stop 72.53, after 4 hours close below 72.55, or retest 72.60 stop loss, 72.95 take profit 1, 71.25 take profit 2, 70.10 risk, air reward, 1:4.2 are invalidation. Void if daily close above 73.69. Strategy 2, the active trader, standard. This strategy leans on the mean reversion to broken support turned resistance. Entry condition, a pullback into the 7325-7330 zone, which is the confluence of the 4-hour 50 EMA at 73.12 and the lower bound of the prior value area. Wait for a 1-hour bearish engulfing candle or a rejection wick at this zone with an RSI cross below 50 on the 1 hour. Entry: short at 7,328 with a limit order. Stop loss is placed at 73.69, above the daily pivot. Why? Because 73.69 is the binary invalidation level for the entire bearish move. A break above that signals a structure change. Target 1 is 7,255, the first major support, for a 73-point gain. Target 2 is 7,180, a midzone between S1 and S2 where liquidity pools. Risk is 41 points, reward to target 1 is 73 points, giving a 1:1.8 minimum. To target 2, roughly 148 points, 1:3.6 R. Once target 1 is hit, move the stop to break-even and trail by 30 points on the remainder. This setup gets voided if the 1-hour candle closes above 73.45 before the entry triggers, suggesting buyers have regained control of the 4-hour trend. The active trader, standard, entry, short 73.28 limit, rejection at 73.257330, stop. Loss, 73.69 take profit 1, 72.55 take profit 2, 71.80 risk, reward, 1:1.8 R, TP1, 1:3.6 R, TP2, invalidation. Void if 1H close above 73.45. Type your S&P 500 range for tomorrow in the comments now. I want to see how many of you are mapping 72.55 to 73.50 versus a breakout. Strategy 3, the aggressor, high risk. This is for traders who can stomach tight stops and ride momentum on a continuation breakdown before the 7,255 level is tested cleanly. The setup triggers on a 15-minute break and close below 72.60 with a strong bearish Marubozu candle and a CCI below -200 on the same time frame. Entry: short at 7,258 with a market order, aiming to ride the acceleration into the S1 test and possibly a straight-through flush. Stop loss is placed at 7,277, just above the 5-minute breakdown point and above the 15-minute pre-break consolidation high. That's a tight 19-point stop. Target 1 is 7,230, a liquidity level just above the 72.55 magnet where many stops will rest, offering a quick 28-point scalp. Target 2 is 7,180, giving a risk-reward of 1:4.1 R if reached. This is a high-risk trade because false breakdowns on small timeframes are common. If price reclaims 7,275 within 5 minutes of entry, cut it immediately. This setup is invalidated if the 15-minute RSI doesn't stay below 35 for 2 consecutive candles after entry. Only take this if you can lose small and manage risk aggressively. The aggressor, high risk, entry, short 72.58 on 15M close below 7,260 with bearish momentum. Stop loss, 72.77 take profit 1, 72.30 take profit 2, 71.80 risk, reward, 1:1.5 R, TP1, 1:4.1 R, TP2, invalidation. Reclaim 72.75 within 5 minutes or 15M RSI greater than 35 for 2 candles. Never risk more than 1 to 2% per trade. No positions through high-impact news like CPI or FONC minutes. Stops are non-negotiable. This is how you survive to trade the next big move. We are in a volatility expansion. Position sizing must adjust downward accordingly. The single most critical level for the next session is 7,255. A daily close below that number, and the S&P 500 will likely accelerate towards 7,123 within days. If 72.55 holds and we reclaim 73.69, this entire bearish sequence is a bull trap and the melt-up restarts. Watch that pivot. Tomorrow, I'll focus on the Bitcoin risk asset shadow and the S&P 500 divergence that just widened. BTC is holding critical support while equities bleed. That correlation breakdown is a massive signal. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen, smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.